Today, joining us to dig into the beaten down tech sector is Rosenblatt's Barton Crockett. Barton, interest rates rising seems to be the big headwind for tech. And just when you think that that's, seen enough of it for the year, we had Powell in the Jackson Hole speech. We had Powell again today reiterating he's going to be tough on inflation and that the market shouldn't expect a change. So can you own tech in this environment?
Well, I think you have to have tech because tech is the future of humanity. I mean, there's really three things that drive society, right? That is war, historically speaking, war, culture, and technology. And of those three, which are all active right now, tech is uniquely investable. The thing about tech, though, is that technology is our Darwinian battle of winners and losers. And I think there's this false idea of you can buy chopped stocks that are cheap because there's a reversion to the mean. Guys that are in tech are viable. You want to buy them when they're cheap, but that's not always the case because guys will lose, and those are the ones you don't want to own. So I think in tech, you look for winners at a reasonable valuation in areas where the secular tide is going your way. So I think you can, in this environment in particular, you can be very selective and get some great companies. And some of the ones that we're looking at right now would be people like an Alphabet that I cover with a buy rating, $156 price target. My colleagues at Rosenblatt are recommending AMD, Marvel, and Microsoft as other big tech winners. Losers that I think are unsafe in this environment would include Intel, covered by Hans Mosesmann with a sell rating at Rosenblatt, and Warner Brothers Discovery, people who are losers in this great kind of epic battle, Darwinian battle for the future of media and technology.
Well, you gave us a lot to work with there. We're going to bring Brent Thill into the conversation as well from Jefferies, who covers the sector. Brent, I asked basically with rates on the rise whether you can own tech right now. And my next question is what's happening with earnings expectations in this sector? Because a lot of the names Barton just mentioned, Alphabet, Microsoft, are exposed.
Yes, Sarah. Most of the multiples have been impaired severely. Most of the tech stocks are down 20 to 60%. So they're already implying the rate rise and the fear of cuts. So we've actually been seeing companies going up on earnings. Stocks are going up on earnings because they're clearing the deck, saying the macro's having an impact. Our clients want to see that. So I think a lot of this is already felt. We're not out of the woods. This may get worse into early 23. I think Q1 of 23 may be the clear the deck from a company perspective that they're seeing the full macro picture. It takes time for the macro to show up in technology, especially in software and internet, where I cover it more in software. So it's a lag. But I do believe a lot of it's already baked in. I think you have to be selectively buying names like Amazon, Google. We continue to like Amazon here as well. NVIDIA from a semis perspective, Mark Lepasis covers that for us. So there's a handful of names that we're recommending, but again, it's a dip your toe in. I don't think it's back up the truck quite yet. I think we're almost there. Q1 of 23 may be the kind of final clear the deck, and then I think we've got a better trajectory.
I feel like, John, you're nodding. You agree with that assessment?
Well, this is a blue chip show, and he kind of covered all the blue chips right there. So I think Amazon, Microsoft, Apple, Google, those are all very attractive long-term stocks. And the fact that they all split, it makes them very attractive for people who want to put them into. But if the economy gets
worse, have the expectations, have they come down enough for earnings? That's the question.
Well, I mean, the NASDAQ is down 25%, and some of the names in the NASDAQ are down 70%, 80%, 90%. So, yeah, I think that we've seen a pretty across-the-board takedown of recessionary risks right now, 75% price.